I'd like to welcome everyone to the second session for the SOSV Climate Conference, How to Prepare for an Early Stage Financing with our fantastic lawyers, Goodwins. We have Andrew Sparks, who's a partner at Goodwins, David Breck, one of his senior associates, Lindsay Hole, who's the CEO at Dispatch Goods, a fantastic circular economy startup, Insia Jaffarari, Insia, apologies, I should confirm to put your name correct, at Shellworks, which is another awesome startup making a compostable plastic product. Joanna Lichter at a associate director at Emerson Collective, and I believe we're ready to start this session.
Okay, great. Well, thanks so much, Hugh and the SOSV team for organizing this whole event. It's really great to be here with everybody today. And we have a small presentation, but mostly panel discussion today on how a company can prepare for an early stage financing round. And as your hosts, you have myself, Andrew Sparks at Goodwin, and also David Brecky, senior attorney here as well. And so we can go ahead and introduce our panel. And so, as I mentioned, I'm Andrew at Goodwin. I'm a partner in the San Francisco office as part of our technology companies practice, and I'm the co-chair of our climate tech practice. So we have about 60 attorneys globally who are all focused on working with companies in the climate and sustainability space. So we represent a lot of climate tech startups, as well as some of the leading investors as well. And then just stepping back for folks who don't know, Goodwin is a global law firm focused on startups and innovation. We have about 1,800 lawyers, so it's a big firm, and we're excited to be here today. And so I'll kind of let everybody else here introduce themselves, and we'll kind of go down the line, but I'll just briefly say that we've got David Brecky here, also from Goodwin, Lindsay from Dispatch Goods, Insia from Shellworks, Joanna from Emerson Collective, as well as Viri from Galvanized Climate Solutions. So maybe we can go down the line and folks can introduce themselves. Dave, do you want to jump in? And if Dave is having audio issues, maybe we go to Lindsay.
Sure, happy to jump in here. Yeah, I'm Lindsay Hole, founder, CEO of Dispatch Goods. My background was relatively unrelated in that I worked in the cardiac operating room, but got into the sustainability space when I was living and working in Hawaii. And Dispatch Goods essentially is a circular logistics platform that helps businesses stand up returnable packaging programs.
Okay, great. Insia?
Happy to jump in. So I'm Insia. I'm the CEO and co-founder of Shellworks, where our vision is to materialize a better future by eliminating plastic waste. And the way we do that is we create materials that are made and unmade by microbes, so that you could create solutions for packaging or new materials that essentially don't leave anything behind when you dispose of them.
Hi, everyone. I'm Joanna. I'm an early stage investor at Emerson Collective, where I focus on investing in pre-seed through Series A companies in climate tech. Emerson Collective is an organization founded by Laureen Powell Jobs and the belief that the world's toughest problems require unique and interdisciplinary solutions. For that reason, in addition to our venture capital fund, we also have a philanthropy team that does nonprofit grant making and a policy team that does advocacy work based in DC.
Amazing. Viri?
Hi, everyone. I'm Viri Maxwell, a partner at Galvanized Climate Solutions. I help run our venture and growth fund here, which is $1 billion pool of capital focused on investing in companies driving near-term emissions reductions. So we're focused on kind of early commercial and growth stage businesses that have a material emissions impact in the next decade.
That's great. Well, yeah, thank you everybody for those introductions. And So just high level agenda, we're going to cover just a couple quick slides on some of the most common issues we see with startup companies in terms of getting ready for financing, and then we'll jump into panelist discussion with our great panel today. So some of the most common things that we see are just some pitfalls around stock and stock issuances, and that's really around making sure that the company creates an equity plan, making sure that employees, founders, advisors are all properly equitized, own the stock that they think they own, have the economics in the business that they think they do, and the voting power and all that. So just very important off the bat. And then for folks who are in the US in particular, and sometimes something for people to think about even abroad if they're thinking about eventually moving to the US are things like 83B elections, which are an important tax filing to make with the IRS when your stock is subject to vesting, which is a common thing for startup founders. The notion that if you leave a company early, any stock that's subject to vesting can be repurchased effectively by the company. So 83B elections, very important when you have stock that's subject to vesting. Another item here is just making sure that when you are granting stock, you're doing so at the fair market value. You're not creating a bunch of kind of tax problems for yourself or also the company as you move along. Another item that we see, and there's a lot of kind of angst about this at times with founders and early employees, is just around properly allocating the stock amongst the founding team, early employees, advisors, making sure that everybody's aligned and kind of in sync on the allocations, and that everything is kind of set up well from that perspective. There's no real hard and fast rules necessarily around allocations. It can depend on the team and their contributions, but this is something to really kind of keep a close eye on. Another area where we see a lot of issues is just around the employment rules, and particularly things around kind of minimum wage rules, worker misclassification, making sure that folks who are working for the company are being compensated in accordance with the rules that govern wages. And you certainly don't want some sort of wage and hour litigation against the company. And then also the idea that you're properly classifying service providers as either employees or contractors. And there've been, some developments in the rules around who is properly a contractor and who isn't. And so just keeping a close eye on that, because that can create kind of tax problems and wage and hour issues and so forth. And so if Dave is back, we can have him maybe jump in on this slide, or I can keep going if he's having any audio issues.
I think I'm okay here. Can you hear me now?
Yeah, we can hear you. That's great.
Yeah, I think we know, once the robots take over, who they're coming for first. So you guys are all safe, at least at the beginning there. So yeah, I think this is an interesting slide for us because, probably 2/3 of our time we work with these startup companies with these amazing solutions, and the other third, roughly speaking, on the other side. And so coming in, our orientation when advising startups is, hey, what are things when you go into your fundraising rounds that you have to have the box checked? And if you don't, it can send a bad signal or delay closing, or even worse, jeopardize the deal. So having the IP in the company, investors will take plenty of risks on team and product roadmap and strategy, but having the IP isn't one of them. So you have to get that buttoned up. The sooner the better. That's one of the things to invest in early on, or to address as soon as you identify it. Making sure that your confidential information stays confidential. That's NDAs, making sure you have a good form on that. Some forms are not good, you kind of define. Most of them are fine, but there can be some bombshells in there that just come from, where did you get your form? And number 3, I think this is kind of on this is an important one that gets overlooked, is keeping your documents really organized. You know, on the margins, it makes things much more easy to communicate to investors and team, and to know what you're doing. Hey, where is this? Where is that? Educates, you know, how you're going to execute on your plans. It also makes interacting with legal much more efficient. But in the worst case, hey, here's a piece of paper we didn't know about, and now we took another action, and because our data room wasn't well organized, we actually did something wrong. So it's an unsexy part of it, but it actually kind of has an outsized impact on how you can go through raising money, because that does get scrutinized as you do that. Moving over to the right side here, there are securities laws. Securities laws exist. You know, a lot of times startups are one of the key skills of early stage founders is kind of doing things really efficiently and kind of, you know, being efficient. But there are securities laws, so you can break them, and they're not a huge burden to comply with, but so it is something to manage. And you want to comply with those as you go, because that can be more expensive to clean up later on. And maintaining good accounting of your dilution. So you're giving team, you're giving advisors, you're giving investors all pieces of the cap table to incentivize everyone, you know, rowing in the same direction. And that math isn't so easy, right? To track. And I know Lindsay and Insia, sorry for combining your names there, have both, you know, gone through this. And, you know, we first raise on safes, and then we go into the price round, and those interplay with each other in ways that, you know, if you're a first-time founder, even if you're a fifth-time founder, aren't just necessarily intuitive to you. So that's something to make sure that at least someone in your team, or maybe outside legal, can really make sure everyone really knows what's going on. That's the most important thing, is to have a really big, clear vision of where that stands as you go.
That's great. And so maybe what we can do here is just sort of jump into the panelist discussion. And what I thought we might do is just, you know, kind of ask a few questions to the panel, also see if there's some folks in the audience who have questions and kind of want to jump in as well. These things are always more fun when they're interactive. So I'll throw out the first question here to Insia, which is just, you know, how did you build a great group of founders and maybe early supporters, early angel investors, perhaps, to build support and really evangelize for the company going into its fundraising round?
Yeah. So I think, to be honest, it was an interesting one, especially at the very, very early stage, like pre-seed. And I think the rule of thumb is probably you know more people than you anticipate. And it's something now we use a lot in recruiting, is like your referral mechanism, because referrals are always great as you build an early stage team as well. But I think the same applies to investors, is someone you know is most likely to know someone. So sometimes it was cold outreach, and that was totally fine when it came to founders. Sometimes it was through the universities that you attended, or it's just friends of friends. And the key thing is just to try and get like one call in. And my rule was always just to have an ask at the end, which was, can you introduce me to 3 more people who you think are relevant? And then it kind of snowballs from there. And before you know it, you have a really good group of people that you also just have a lot of synergy with, that are, they're your people who kind of help you in the very early stages to get that early funding round. And then you can always build from there, because then you have your first investors and they know a lot of people, and then it becomes a lot easier from there.
That's great. Dave, did you want to jump in with the next question here?
Yeah, I think so. You're kind of talking about a network effect in that would apply to growing your team and to founders and to investors. Is that right?
Yeah, exactly.
Yeah, and does that and so you're kind of saying that word, it's kind of word of mouth, and is that the same to Viri and Joanna? Is that the same the way you see it working out on the investor side, in terms of how you credibly grow the pipeline, and how the top of the funnel works?
I can chime in on that. I'd say we kind of look at the top of the funnel several ways. In terms of network effects, for sure, I feel like the best inbounds for us actually come from our portfolio companies. So anyone they recommend we meet with, we always take that intro. We also do a lot of kind of thematic landscaping work. And so we'll outreach to companies directly in themes we're interested in. And then obviously beyond that, if somebody that's kind of a trusted source in our network, whether that's a frequent co-investor or a frequent collaborator on the legal side, makes a recommendation that we meet with somebody, we also certainly take those as well.
And I totally agree with Viri. I think there's nothing quite like an introduction from one of your portfolio founders. I think those tend to be the highest quality of referrals, and it's really kind of as close as you can get to just meeting a founder at the very beginning. And I would also say that events have been a really great source of deal flow for us, just generally hosting events around certain themes, whether that's something like EV charging or AI and climate, or pick your topic, just gathering folks who are generally interested in certain themes that you're looking into. And then, of course, just generally networking with other venture funds, universities, etc.
Thank you. And Lindsay, does that align with your experience too? I know you've had. I'm biased and a big fan of yours because I've been with you for a long time, seeing you grow the team, seeing you grow the investor base, and I'd love to hear your thoughts on that same topic.
Yeah, absolutely. It was a network, and it took us, I would say, a little bit at the pre-seed stage to find the right types of investors. So we maybe coming out of Berkeley, there was a lot of deep tech, and we were more in kind of climate tech and logistics. And so it took us a second to build out an investor base and network. And I would say that, the learning that we had, or maybe the way that we ended up prioritizing in competitive rounds, was just like, I always ask myself, are these the people I want to run to when times are tough? Do I want to tell them like what's going right and what's going wrong? And so that's been kind of the litmus test as we've gone out to raise. And I think that on our end, the way that we kind of attract those type of investors is just being radically transparent and as authentic as we can, coming to the table about what this business is going to be like to build. I think that then you kind of weed out investors that may have a different vision for your company.
That's really great. All very helpful to hear. I wondered, Joanna, maybe if you could talk a little bit more about maybe some of the benchmarks and metrics that you're thinking about and looking for when you're evaluating early stage companies, and maybe this can help provide some guidance to any of the founders in the room.
Sure, happy to. So I would say in general, it's hard to use benchmarks across the entire early stage continuum because companies are at all different stages, anywhere from an idea and a pitch deck all the way to several millions in revenue at the Series A stage sometimes. Additionally, whether you're a software or hardware company, your metrics will likely look quite different. And depending on if you're selling to consumers or enterprises, that also changes things. But I'm happy to talk somewhat high level across the three stages, so pre-seed, seed, and Series A. So at pre-seed, typically we're evaluating the strength of the team and the overall market size and opportunity. Most of the time at this stage, founders are pre-revenue or even pre-product. And so it really is about understanding what is the size of the market, do we believe in potential opportunities to expand the market size, and really just understand the vision of the founder and understand if it's a match for us at Emerson. And then I would say at the seed, typically that's when a company will have a product in market. Again, it's not always the case, but generally we'll see this. And at this point, we're looking for evidence that the company is on the way to finding product market fit. Certainly, we don't expect it to be there 100%, but we want to see evidence that the business is starting to work. So that means that if you have a product in market, maybe you're generating in revenue, we try to look at things like how fast is revenue growing, how long is it taking you to reach certain metrics, whether that's 500K or $1 million in revenue. Just really understanding what the velocity is starting to look like in the earliest phases of the business. And then lastly, at the Series A stages, I would say We've seen some of the best companies have, 2 million plus in annualized revenue. Again, this is easier for software companies than hardware companies. We really like to see strong growth rates. So maybe you're growing, 3 to 5x year over year. And again, on the software side, some healthy margins. I want to emphasize again that these are kind of broad-based and look really different, again, depending on what kind of business that you're building. But in general, that's typically what we look for across stages. Yeah,
that you touched on the point that I often have to counsel a lot of my clients through who are in climate. Like your ramp up in ARR might be totally different from a software company, and so you're on some ways you're going to be held to that same standard when it comes to translating that into valuation, into interest. But it's different. It's different for companies that have hardware or different, operations products beyond software. So that's common. That's common in the space for sure. And turning it to Viri now, I got this question this morning actually, before this event, and client asked me, what's going on in the space right now? The market's obviously choppy. There's a lot of uncertainty that affects everything. It may or may not, be affecting climate differently than other places. Do you have a sense of how do you as an investor change your outreach, your round execution in market economics like this?
Yeah, I'd say I think in terms of guidance we're giving to our portfolio companies, obviously I think staying as lean as possible to make sure that you are, to Joanna's point, kind of as close as possible to achieving the metrics of value creation you need to achieve before you need to go out and raise money. Because I do think in the climate category, there is a lot of capital that wants to be deployed into climate solutions. But right now, because of the market context, everyone would like a safe bet. And so obviously that for a lot of folks is going to take the form of complete team, like demonstrated achievement of metrics. And I'd say by that, those can be financial. If it's an earlier stage hardware company, those may be technical, whatever those appropriate metrics are for the business. I think, staying laser focused on those and being as capital efficient as possible to achieve those is going to make it a lot easier to raise capital. Right now, I do think we're in a choppy market. And so there is definitely fundraising is taking longer, and it is often, with more structure or a different set of terms than a lot of folks have been used to in the last couple of years. And so I'd also say, I think, making sure as an entrepreneur, you can really articulate the clear steps you are going to take to build a really substantial business, as Joanna already said, in a big TAM market, what you have to do from a product development standpoint to get there, what the customer ROI is. I think the more clearly you can articulate that you understand those things, even if you've not achieved them yet, the easier it is to raise capital right now.
Yeah, I think that's really great. I think it's a perfect segue to, I was going to ask Lindsay this question because she, having sat in on some of the meetings, has done a great job explaining all that stuff. And she's coming in with a business model that's more complex than just software. And one thing that struck me about how she did this was that she has actually a really strong team who is all capable of telling the whole story, or at least that's what it seemed like to me. But also, adding on top of it, Lindsay, you had an additional issue. It's a choppy market, interesting, really unique business, and another person you were taking care of the whole time. You want to talk about that experience?
Yeah, I am just excited to touch on this because I felt like going into the end of last year with a choppy market, and going out to raise, I was also very pregnant. And I'd seen a couple LinkedIn posts about success stories. We closed the round. 10 days before, the day before I gave birth. The raise took longer than I think past raises had for us, based on the market conditions. And at some point, it was like, I'm going to be raising through giving birth. And that's how things panned out for me. And so I just want to, it was interesting before kind of the round came together. I was on a lot of the panels for climate tech and women founders. But every time I would finish a panel, there'd be like a line of women that were like, I've never seen a pregnant founder before. So I just wanted to share the story about kind of like that there are women that don't always close the day before they give birth. Sometimes it goes through that. And we got through it based on, I think, the strength of the team that Dave is alluding to, that I had around, kind of like propping me up so that I was just attending the major pitch sessions when I was postpartum. But the thing that I'll say that may be important and goes back to the initial point about who your early investors are, is I noticed when I went out to raise, I didn't necessarily talk about my pregnancy as being why the timing of the round was as it was. And by the end, I just, in the very initial conversations, I had to start saying, hey, listen, this is what I'm up against. There's going to be an interruption in this raise. And what I found is that like level of transparency potentially made the round come together faster. And I think with the type of investors that we're really excited to have on this journey with us. So it's just another, I think, data point for transparency in the fundraising process. It wasn't something that I was necessarily purposely withholding. It wasn't necessarily in the first 5 minutes of conversations. I actually changed that and put it in the first 5 minutes of conversation by the end. So it's a journey. And if there are any other women going through this, feel free to message me, because it's something that I kind of felt isolated in my experience the first time around.
And I'll just chime in and say ditto on the investor side if anyone else wants to have a conversation about that. We also raised the fund when I was pregnant with my second, and I feel Lindsay on this issue deeply, and yes, happy to talk to anyone about it if it is an area of interest or you have questions about it as well.
So refreshing to hear that.
Yeah, that's really great to hear. And I think, part of all this is just building community, and particularly within, I think, the climate space. We have a great community going, and founders and investors all supporting each other. So thanks for sharing those stories. I think we're basically kind of coming up on time here. So really appreciate all the participation from the panel, and encourage folks to reach out to members of the panel, as well as to Dave and myself if there's any questions or feedback, or you just want to get in touch. Please feel free. But thanks very much again to SOSV for putting on this great summit, and then of course to our amazing panelists. Thanks so much for joining the conversation today, and just look forward to being in touch with everybody.
Thank you.
Thanks for having us.